Hello, and thank you for joining me in today's seminar about building long-term wealth. This is financial education, and I think that by tuning in for today's video, I think that you're taking one step to achieving financial freedom, and not just financial freedom, but planning for the future. If you're living in China and you're out of your home country for quite some time, you might not be contributing to a pension or qualify for pensions when you're old. And let's face it, while we love what we do, we might not be able to work forever, and there will come a time where we will need to rely on the financial preparation that we have made to sustain ourselves for the golden years of our later life. So I want to start today's presentation by telling you the best time to plant a tree was 20 years ago. The second best time is now. So let's get started on today's presentation. Here's an overview. You can pause the video just to take a look at all the different topics that we are going to be covering in today's presentation. I want to start with a disclaimer, though. I want to say that this is not financial advice. This presentation is for educational purposes only. I'm telling you about investing and how to understand investing and how to make decisions. I'm not making those decisions for you. I'm not telling you where to invest your money or what to invest your money in. We are adults. We make our own financial decisions, and we are responsible for our own investment choices. Also want to say that past performance does not equal future returns. I'm going to be throwing a lot of percentages around in this presentation, but I just want to state that historical results do not guarantee future performance. Taxes vary by country, and tax laws and regulations are different depending on your location and depending on your citizenship. I will be talking later about what a taxable event is, but I want to state that you are responsible for understanding your tax obligations in the countries where you are considered a resident or you're a citizen of which country. That is your responsibility and yours alone. And I also want to say that there are different paths to wealth. There is no single way to build wealth. Your journey is unique to you. Today's presentation, I want to tell you right away, is focusing heavily on equities. Equities being stocks, the stock market, funds. But I want to say that a lot of people have built a lot of wealth in different ways, such as real estate. I will not be talking about real estate investing in this presentation, but I have complete respect for people who believe that real estate is their path to wealth. There are different ways to leverage your equity in home ownership to acquire other properties, and through renting and tenants and property appreciation, you can build a lot of wealth in a very short or long amount of time. But I'm not qualified to speak on that, so we are not going to be discussing that in today's presentation. Just to say, knowledge is power, use it wisely. So let's get started. Okay, so I'm going to talk a lot today about the power of compound growth. You've probably heard the power of compound growth before. That is going to be an overarching theme. So that is that growth on top of growth. When you invest consistently and you earn returns, those returns to begin to earn returns on returns too. So the earlier you start, the more compounding happens, and it is a slow journey that accelerates in the later decades. It is never too late to start, but the earlier you get started on compound growth, the more heavy lifting. The money you save today ends up doing the heavy lifting of your investment growth decades down the road. Okay, so this is about long term, and this is about planning. Before we even start talking about how to invest and the power of compounding, we need to actually set retirement goals. So I want to tell you an industry standard about withdrawal rules. Now, this is the part of the presentation that ends up being a reality check for a lot of people, but to fund your own retirement and not run out of money, you do need a lot of money. So there are different withdrawal rules designed to make sure that your bank account and your investments live longer than you do, because you don't want to be running out of money in the final years of your life when you are physically the least able to work. So there's something called the 3% rule, the 4% rule, and the 5% rule, and they're essentially the same rule, but they're different levels of conservatism about your withdrawals. But they essentially say the amount of money that you have invested, however you have it invested, you can withdraw 4% of that every year. And no matter market upturns, downturns, inflation, if you're withdrawing between 3 to 5% from your investment pool every year to sustain your living, your investments will outlive you. And let's be honest, we don't want to die broke. We would like to leave money for our loved ones. So these are good rules to follow. So according to this rule, if you want to live, so for example, if you want to live off of $4,000 a month, according to the 3% rule, you need about $1.6 million. Now, you can be more aggressive with your withdrawal rates, and you can have a $4,000 a month withdrawal rate using the 5% rule at $960,000. But as you can see from this math, you do need significant amounts of money saved, and let's be clear, invested. This is not just cash sitting in a bank account earning almost no interest. This is the money that you have invested. So this is a reality check. So you need to plan for your own future. You might still have other income. You might have a pension. Your parents might have set up some kind of a trust for you. You might have other forms of passive income. But then on top of that, you still want an additional $2,000 or $3,000 a month. $1,000 a month equals $12,000 a year using the 4% rule. For every $1,000 I want to have a month, I need to have $300,000 invested using the 4% rule, which means if I have $3 million, that's $10,000 a month or $120,000 a year I can have, which buys you a very comfortable living in almost every part of the world. So you set these targets for yourself, and then how much do I want a month times by 12 equals the amount that I need to withdraw for a year. Take that amount, divide that by 0.03 for 3%, 0.04 for the 4% rule, and that gives you the balance that you need to achieve that desired monthly income that you are going to provide for yourself, okay? I want to provide a very quick disclaimer because there's different strategies for how aggressive your investing should be throughout your lifetime, and I'm not telling you how much of this balance to do with your current portfolio. You make these decisions yourself, but I want to explain the theory. So the younger you are, the more aggressive you can be with your investing. What do I mean by that? What do I mean by you can be more aggressive? I mean, how much of your money is in the stock market, whether that is in the form of individual stocks, funds, ETFs, which we'll talk about later, and how much of that money is in more conservative places, such as fixed income, such as government bonds, fixed assets, term deposits that tend to return less, but they give you a fixed income. Very conservative. Stock market, very risky, very aggressive, but with risk comes more reward. So the theory of investing through your life is the younger you are, the more investment risk you can take. A person in their 20s who has their entire portfolio in ETFs in the stock market, that person is theoretically much more tolerant to a market crash, because if they're making sound financial decisions and being patient, they're not going to need the money they have invested the day after a crash, and they're not going to panic sell because they're going to hold these portfolios for decades to come. However, a person in their 50s or 60s or 70s needs to be much more conservative about where they're putting their money because they have less tolerance to market volatility. Just imagine if you had all your money in the stock market and then the day before you retire, there is a crash of epic proportions like the financial crisis in 2007, 2008, or the dot-com bubble. That would be tragic. So this is just a reminder that the younger you are, the more aggressive you can be, but as you grow older, you can transition into more balanced fixed income. Okay, so I want to give you a tool, how you can use chatbots to help you model your financial growth. And I want to explain the numbers that I use. So I tend to use, again, I'm throwing these around, but historical returns do not guarantee future outcomes. But historically, the S&P 500, which is an index that measures the biggest 500 companies in US stock markets, over the course of decades and 100 years, 100 plus years, have returned about 10% in annual returns. Now, in the United States and much of the English-speaking world, inflation on average over decades has been annually between 2 to 3%. So when I'm creating a financial model using a chatbot such as ChatGPT, I will use a real return rate of 7%. 10% minus 10% for the average returns of the overall stock market, minus 3% for inflation, so I get 7%. So when I'm using ChatGPT to make a calculation about how much money I'm going to have in 40 years, the money that I'm seeing at that final figure is stated in today's dollars. Because if we don't make that adjustment, having a chatbot tell you you're going to have X number of $1 million in 40 years, that's a bit meaningless because you don't know what $5 million will be worth in 40 years. But we use that inflation adjustment to see it in today's dollars. So when you're talking to a chatbot, use 7%. If you want to be even more conservative, use 6%. You want to be less conservative, use 8%. But that's the theory behind this calculation. The next thing I do when I'm talking to a chatbot is I divide my financial life into 3 different phases. The first phase is the wealth building stage. That is essentially when you are working, when you are in your 20s, 30s, 40s, 50s, or even 60s, when you are working and you're saving money. Now, granted, things happen in life. Unexpected tragedies or unexpected miracles, such as children, will affect how much you save, and you can factor that in to your wealth building stage. Also factor in that as you progress in your career, your income traditionally is going to be increasing, but you essentially tell the chatbot during the wealth building stage, how much money am I saving every month? Now make sure you are saying I save this every month, and when you talk about the return rate, the 7%, you remind it that that is annual. That is an annual rate. Now, the second stage I use is a semi-retirement stage. You can skip this stage altogether, but more and more people are semi-retiring, which means when they retire, they start working part-time. And so what happens is your withdrawals either don't exist or you have significantly less withdrawals because you're still working part-time. So you can see on this curve here during the wealth building stage, my wealth accelerates. And then in stage 2 of semi-retirement, my wealth is still growing, but not as fast either because I'm no longer saving or I'm even starting to withdraw a little bit. And then full-on retirement, where I am now sustaining my life fully from my withdrawals. So we can see my net worth is on decline. Sometimes when you model this, if you have a significantly affluent net worth, but you're living a modest lifestyle, you will still see, for example, if you have $5 million, but you're only living off of $70,000, $80,000 a year, then your wealth will continue to accelerate. And honestly, I think it's a great choice for your loved ones if you don't want to plan to die broke or almost broke. You want that financial security throughout the rest of your life. You want your wealth to continue accumulating because, let's be honest, you'd like to leave something for your next generation. But I strongly encourage you to use 7%, 6%, 8%, and start having these conversations with a chatbot about different models. Now, you can also implement into the model, you can say, can we simulate crashes, however often crashes, 8 to 12 years or 8 to 15 years, and you can ask the chatbot, can we be more conservative, can we be more volatile with these projections? And you can say, can you model different graphs? Can you show me the difference of if I save $1,000 a month, or if I save $5,000 a month, or you can even say, I save $1,000 a month, but every year my ability to save increases by $100. Now remember, because you're using that 7% growth rate, every number that you speak about has already been adjusted for today's dollars, okay? But start having these conversations with chatbots. It will build your confidence. It will also build your capacity to plan for your financial growth. All right, so now I want to talk about the emotional part of investing that nobody tells you about compounding. So Early investing feels very unrewarding. It feels like nothing is happening, and it can feel like your first $100,000 takes forever to get. But once you get past that $100,000 point, your investment starts to do a lot more. So think about that for a second. So on a daily basis, equities go up. The stock market goes up by 1, 2, it can be volatile, 3%, or it can go down by that much. Now, when you've got $10,000 saved and you check your account every single day, your balance is going up by $100 to $200 or down by that, and it feels like nothing is happening. And then after a year, you're reading in the markets that it's been the best year in the stock market ever. Returns are up 25%. Well, on your $10,000, that's $2,500, which doesn't sound like a lot of money. It took you a lot of hard-earned dollars to get that balance to $10,000, $20,000, and then you're reading in the news about miraculous returns in the stock market. Things have never been better, but your account is barely moving. But that all changes. Actually, a lot of people tell you it's the $100,000 mark where you start to experience, wow, now my portfolio is really moving and it's moving by itself. But there's another school of thought, and I tend to agree with it, that you actually don't really feel that until you get to the $200,000 or $250,000 mark, because that's a point where a daily change on a volatile day in the stock market is going to go up significantly to the point where you look at the number and you say, wow, my net worth increased today by more than I'm going to spend on my entire holiday. Now, this is a key psychological turning point. Yes, your wealth starts growing significantly at the $250,000 mark, but then your emotional maturity needs to grow with it, because like I said, you start to see your net worth going up by thousands of dollars every day, or even down. Or if there's a significant world event, negative or positive, you will see your net worth change on a daily basis by up to as many as 5 figures. You never forget the first time you see in your bank account your net worth go up by $10,000 or go down by $10,000, simply because a head of state in a country made a very politically provocative statement that created uncertainty in the markets. And then that is affecting your balance. So this is a turning point where a lot of people start to panic when markets go bad, and they start to think they've already made it when markets are good, and they start to abandon their savings plan. If you can stay with your plan to the $500,000 or $1 million mark and get past that, you will build not only your investment portfolio value, but your emotional stability around market volatility. And when you get to the 20 or 30 year mark, now I'm not going to pretend to say that I've been in the market for 30 years, but the modeling shows that that is where the acceleration takes off. But you're building this wealth over decades, and that is important, because when you get to a 7-figure net worth, you need the emotional stability to see your net worth go up or down in a year by the value of some people's homes, okay? The hardest stage is usually the beginning. Stay consistent, be patient. Time is the ultimate multiplier, okay? You can pause, take a look at that graph if you need it. Okay, the next thing, I just want to talk about debt and wealth killers. The first step in your financial journey is getting out of debt, because debt tends to be very high interest, whether that's credit card debt, car debt, you've got leases, obviously home ownership, that's a whole other issue. That interest tends to be significantly lower than those other kinds of debt. But your first goal, if you are in debt, is to get out of debt. Everything I've said about compounding and how that works for you over decades, over time in your investment journey, that is also true for debt and how it works against you. Debt interest compounds violently against you over time. So if you are in any kind of debt, your first goal is to get out of debt. Odds are the debt on your credit card is going to be the percent on that debt the interest on that debt is going to be much higher than anything you're going to get out of the stock market. Get out of debt first, worry about investing later. The next thing is lifestyle inflation. As you grow in your career and your income increases, you get promotions. Don't fall victim to, as your income rises, so does your expenses. If you want to be wealthy decades from now, continue, I'm not saying don't enjoy life, but continue to maintain a modest level of living, okay? Avoid emotional spending, buying things to make yourself feel better. Again, I'm not saying don't live your life, but commit to the planning that you have and don't abandon your monthly savings goals. Pay yourself first is what I always say. Get your money invested into the market every month when you get paid, and you will avoid a lot of that unnecessary emotional spending. Gambling is not only illegal in many parts of the world, but it is also just a financially very stupid decision. I enjoy things like sports and gaming without putting money on the line. Money, you already know this, gambling is not investing. It's just one of the worst financial decisions you can make. And also just lack of discipline. Not having a plan, no consistency, no patience. I'm going to talk later about panic selling and the opportunities that creates for the people who don't panic sell later in this presentation. Okay, so a lot of you probably joined this presentation simply for the question of where do people invest? I live in China, I can't get a bank account in my home country because I'm not a tax resident, they won't set up a brokerage. There are lots of different channels for you to set this up. For example, I bank with Charles Schwab Investments. It's an American bank. Now, even though I am a Canadian-American dual citizen, when I signed up for this brokerage, I gave them my Canadian passport and told them I was a resident in China, living, working, my life is in China, and all they had to verify the account was I had to provide a copy of my police registration in China and my rental contract to prove that I was actually living and working and paying taxes in the country that I claimed to be. Not every country qualifies, but as a Canadian living in China, I qualify for this account. If you're American, it's even easier. But yeah, there's also Fidelity Investments. I've heard of Interactive Brokers. I believe that is in the city of Hong Kong, which is part of China. But there are many. The point is, there are many places for you to invest your money. So before you do anything I've said from this presentation, you need to have that channel set up, okay? Again, do your own research with your own brokerages, but it is possible. I ran into problems with my Canadian bank because I'm not a taxable resident there. They weren't too keen on me purchasing and having an ongoing relationship purchasing investments through their bank, but that's fine. I don't need to bank in Canada. I can bank in California through Charles Schwab as a person who lives and works in China. ETF is essentially what is called as an exchange-traded fund, and you can get ETFs in pretty much anything. I'm not going to tell you what to get them in. There's things that follow certain industries. There's ETFs that follow different indexes. There's even an ETF that follows Nancy Pelosi because people said she was using her political clout to get insider information, and there was an ETF designed to follow her investments. But an ETF, in a nutshell, is a basket of stocks that generally tends to follow a theme. Now, the difference between an ETF and a mutual fund, theoretically, they do the same thing. They buy an investment. But this is an exchange-traded fund, whereas a mutual fund is something you would set up with a specific mutual fund. The details of that difference are not important other than that mutual funds tend to cost more in management fees. And that brings me to the point I want to make about when you're choosing an ETF. It's very important that you look at the expense fee, the percentage that they're going to take from your balance. They tend to be very low, but some ETFs have a higher expense ratio than others. Expense ratio, that is essentially what the ETF charges you. So they tend to be very, very low, but they're important because over the course of decades, they add up. So what is it? So let's say you have an ETF that is an expense ratio of 0.1%, and then I have $10,000 in that ETF. Quietly, $10 gets reduced from the value of that ETF in 1 year. As you can see on the slide, there's an example of the difference between an annual fee of 0.1% and 1%. Is a difference of $11,514 over the course of 30 years. Now, you're going to be investing much more than that over a long amount of time. So if you're paying higher expense fees, or you're paying a financial advisor a percentage point over the course of decades, these fees will actually add up to hundreds of thousands of dollars in lost gains that you're essentially paying. Now, I'm not telling anyone that they shouldn't get a financial advisor. You are paying for peace of mind. Some people don't want to go through the process of learning all these things that I'm talking about and financial literacy and doing their own research. They're willing to pay that fee to pay for someone else to do that. But I just want you to understand that over the course of decades, those fees add up to 6 figures worth of lost gains for you and your family. So yeah, ETFs are the way to go for a lot of people. They give you very broad exposure to a lot of different kinds of stocks. And the danger of investing in a specific stock, no investment is ever a sure thing, but stocks can be especially risky and they require a higher level of diligence. I could buy Amazon thinking Amazon will be one of the biggest companies in the world forever, but I cannot predict the future. I cannot predict what would happen if Costco or Walmart suddenly improve their online sales and their cloud business and suddenly take huge market share from Amazon, and I lose significant percentages of my investment. Or a new technology comes along, as many times in the past has happened, and makes whatever company I've invested in, makes them completely worthless. We've all heard the story of Blockbuster becoming a worthless company after technological innovation made them a essentially useless business. So stocks are very hard to predict. ETFs, you still need to do your research, but they give you much more broad exposure to whatever the themes of the ETF is you've invested in. Okay, now some of you are going to go ahead and you're going to be looking at stocks, and you're going to be preparing to make investment decisions. I just want to talk about some very key terms that come up when you actually open up a stock. So the first one a lot of people don't understand is the market cap. The market cap is the essential market value of the entire company. And why that matters is because it tells you how big the company is. And then you can make plans guessing how big the company will grow to be. I can make a company called Liam Company, and I can make one share, and then that share, and I can sell that share to someone for $10,000. So saying, the stock price of Liam Company is worth $10,000, that doesn't tell you a lot about the overall value of the company. So shares times stock price give you the overall value. So when you're looking at companies that are like Nvidia or Amazon that are worth trillions of dollars, and then you look at smaller companies like IBM that are in the hundreds of billions of dollars, or you look at these new companies that you might have heard about in YouTube videos associated with the supply chain for space launches. These companies might be worth 10 or even single-digit billions. It just gives you an idea of the size of the company and the ability of that company to grow. The next thing you're going to see when you look up any stock on the internet is you're going to see earnings per share. Earnings per share essentially tells you how much profit did the company make for every outstanding share. So if I have one share of Nvidia, how much profit did they make per share? That doesn't mean how much cash I'm getting from them, because profits are distributed in different ways, but it's how much profit the company earned. And just so you know, a publicly traded company that you are buying on a stock exchange has quarterly and annual reports where they have to legally disclose all of this financial information, how much money they made or lost, how much their expenses were. You can find all of that information all online with a quick Google search. PE ratio. PE ratio is very, very important. PE ratio is the share price divided by the earnings per share. But what that means is it tells you how optimistic investors are about the future of this company, and it does that in very different ways. If I look at a company that has a PE ratio of 50 and I compare that to a company that has a PE ratio of 20, that means that the market thinks much higher of this company that has a PE ratio of 50. Now, that can also mean that there's a lot of emotion in that market price. And it means that the profits and the earnings of that company have not yet caught up with what the market thinks about it. So if you hear someone saying that a stock looks expensive or looks cheap, they're not talking about the actual price. There can be a company whose stock price is $500. That doesn't mean anything, that context, unless you're looking at the PE ratio. If I saw a company with a stock price of $500, but the PE ratio is 10, that is a very low PE ratio. I could say that that is a cheap stock versus there might be a company whose stock price is only $15, but the PE ratio is 100. People would advocate that is a very expensive price for that stock because it means that investors have already pushed up the price before the company has performed and brought its earnings. I cannot emphasize enough, looking at the PE ratio tells you the price of the stock relevant to how much money it is currently making. So before you say a stock is cheap or expensive, look at the PE ratio. The price of a stock does not tell you that. The price of a stock could just be expensive because they don't have as many shares of that stock. Okay? PE ratio is what tells you that. Dividends is when money gets distributed to shareholders. Companies can do two things with dividends. They can either distribute them to all the shareholders, or they can reinvest it because they think investing it in the company is going to result in future growth, which is why when you hear that the company that you own made billions of dollars in profit, and then you do the math, and then you find out, well, I didn't get that much in dividends. Dividends are taxable events, which I'll talk about later. But you can see the dividend payout ratio. What percentage of dividends do they pay in comparison to the price of the stock? So when you're choosing stocks, that is an important thing to look at. Volatility tells you how much the stock goes up and down. And then diversification is just a term that people use to talk about how diversified investment your portfolio is. Do I have all my eggs in one basket? And then just quickly below, you can read large cap, mid cap, small cap companies, is essentially referring to how big the company actually is. That's why I said market cap matters. Okay? I just want to talk about risk versus reward, balancing today for tomorrow. Equity, like I already kind of talked about equities, the stock market, that's ETFs, stocks. It's very, very risky. Now, each stock carries different levels of risk depending on the industry they're in or the financial health of the company. Cash is cash, but you need to be aware that cash loses value every day because as the world will be printing more of it. Bonds are when you lend money to a government or a company, you get a return on those bonds. You get paid interest, which is the price of borrowing money. But a lot of financial advisors have argued in recent years that interest rates are so low, they essentially just protect your money against inflation. Real estate, I've done a lot of calculations, and I cannot seem to come up with a way that real estate can produce higher gains in the long term than indexes. However, property is something that if people know an area and they use debt to their advantage and they manage their own tenants, you can build a lot of wealth with real estate, and there's a certain level of peace of mind. The fact that you're owning something physical that you can lean against and touch with your hands as to compared with something you just see on your computer screen. Equity, stock, ETFs, the broader market, and then just growth assets. Highly, highly risky, but time is your greatest advantage, and the younger you are, the more risk tolerance you have. Okay, I just want to talk about taxable events. This is very important. I'm not telling you what your tax obligations are, but I'm telling you what is a taxable event and what is not. When I buy a stock, I am just investing my money. Nothing taxable has occurred at that moment. However, when I sell my stock, I bought Shangyin stock for $1, and then it went up to $11. I sold it. I made a $10 profit. That is a capital gains tax. That is a taxable event. How that gets taxed is different depending on your different tax obligations. When I sell, if I buy Shangyin stock for $20 and then the stock drops to $10 and I sell it, I record a capital loss, which at some point in the future can help me to pay less tax. Okay? I log into my Charles Schwab account and I suddenly realize I have $1,000 in cash in that account that I didn't have yesterday, and I didn't deposit any money. That's because I have received a dividend on some of my investments. ETFs, all sorts of investments, pay different dividends at different times, and those are taxable events because you are being paid a profit. So some brokerages will withhold tax so that you don't end up owing money later, but not every brokerage does that, and not every citizenship or tax residency taxes dividends in the same way. So you need to go out and do your own research and find out what your tax obligations on those dividends are, but dividends are a taxable event. Do not ignore them. Receiving interest on a bond or a term deposit, that is a taxable event, similar to that of dividends. You need to pay attention to that. When I'm exchanging investments, usually no. So that is, I decide to move my NASDAQ ETF from my Canadian bank to my American bank, Charles Schwab. I have not sold anything. There has been no capital gain or capital loss. That is not a taxable event. It is very important that you understand this, because a lot of people, they read in the news, they read, oh, today Jeff Bezos, he made $1 billion in a day. Why didn't he pay tax on that? This frustrates me so much because a taxable event has not occurred. The shares that billionaire owns just increased in value. And if you are going to tax him on simply an unrealized gain that the stock went up that day, then you are going to force him, then how is he going to get that cash? He doesn't just have $1 billion that entered his bank account. Nothing taxable has happened. So a lot of people now in the media, I know I'm getting a little bit political here by explaining this, but it's getting very popular now to say that, oh, they're avoiding tax, has a taxable event taken place? If every time a billionaire made hundreds of millions of dollars because the share prices went up, then you are going to force them to then sell those shares and then pay a portion of it in tax. Well, what's going to happen when Jeff Bezos sells $1 billion of his Amazon shares to pay a tax? Well, then the value of those shares go down, and then I lose money and you lose money. So you want to talk politics about maybe, yes, we shouldn't have the wealth inequality that we have, but that comes down to, okay, what percentages of taxes are people paying on income? Income is a taxable event, capital gains is a taxable event, and dividends is a taxable event. Just because the price of an apartment building went up, the billionaire who owns that apartment building shouldn't have to then sell the apartment building to pay tax on that, because no gain has actually been realized. And when we tax assets in this way, we hurt everyone. So that's my little bit of politics there. But I want you to understand that taxable events, I'm all for rectifying wealth inequality, but we need to understand what are taxable events and what are not. Capital gains, when we sell the assets we own, those are capital gains. Capital losses, dividends, those are the profits that we get paid for the companies that we are invested in. Final thing, and this is the hardest part of the wealth building that I'm trying to encourage you to participate in, and that is poop. Poop is what is going to make you rich. If you are 20 years, if you're in your 20s, your 30s, or even in your 40s, and you're starting your investment journey the way that I have discussed it today, and you're modeling it, you are at some point going to experience market downturns, bear markets, crashes. How you respond emotionally to these markets determine your wealth trajectory. So I call this poop. When there's poop, there's a lot of opportunity. Poop is panic in the market. Panic provokes overselling, which pushes prices down, which results in opportunity and profit. When people sell based off of fear, the people who buy the fear end up getting rich. Stocks go up and down all the time. Markets crash. Now, again, I stated at the beginning of this presentation, historical outcomes do not determine future returns. But historically, what we've seen, enormous amounts of wealth have been made when people buy aggressively during downturns or at the end of downturns. Okay, so make sure you have that mental discipline for your own investment decisions, and If you sell during a crash, that means you are buying stocks when they are expensive and you are selling them when they are cheap, which is the exact opposite of what you want to do. My final takeaway is start early, stay consistent, avoid emotional decisions. And I want to give an example. The wisest words I've ever heard were spend time in the market, not spending time trying to time the market. You will never, ever be able to time the market. The smartest hedge fund managers in the world cannot do that. I spent years avoiding markets because I thought a potential crash was imminent, and I was trying to time the market. And I literally lost hundreds of thousands of dollars in potential gains by being afraid of entering the market. Now, a crash is coming at some point. You read all sorts of doomsday drama in the news, and every time a crash does happen, the noise is always that this time it's different. Let's go back and look. Okay, when the Iran war started, I'm not talking politics, but this is the end of the global economy. Well, what happened when the pandemic broke out and markets crashed? This is a global pandemic. This is the end of the global economy as we understand it. Going back even further, the 2007, 2008 financial crisis. The US economy is tanking and it's going to bring the entire world down with it. Well, what happened every single time? Markets recover, the world moves on. Don't buy into the panic and the fear-mongering, then the noise that is around you when you become an investor. Yes, of course, you listen to the outside world and you stay globally competent and know what's going on around you. But stay committed to your financial planning and to your financial consistency. And as I said, spend time in the market, stop trying to time the market. And one last takeaway, the future belongs to those who plan for it today. You don't need to be perfect, you just need to be consistent. I hope that today's presentation has given you confidence that you will one day achieve financial freedom. Building wealth is usually slow, disciplined, and boring until compounding takes over. And again, this is all just for the purposes of education. This is not financial advice. I'm not telling you what to do. You are responsible for your own financial decisions and your own financial future. But I hope that if you stuck with me through today, then you are one step closer to achieving all it is that you want to achieve, because the future is yours and you deserve it.